So I do think that we're likely in a multi-year, ups and downs, but a longer term commodity bull market until the prices go up enough that enough new Capex comes online and starts the next cycle. So yes, I'm broadly bullish on commodities with different time frames, generally long term, especially centered around energy. Coincident with that would be gold revaluation, basically central banks turning back more towards gold. And then also technology now allows money to pierce borders more easily with things like Bitcoin, stable coins. So I think in many cases, countries are going to have a harder time imposing their own little currency bubble. We're kind of watching the Game of Thrones of money right now, which is a couple leading network effects kind of coming to a head in the years and decades ahead.
In a recent economic and market analysis, macroeconomist Lyn Alden shed light on the evolving dynamics of the long-duration treasury market, pointing out the significant shift towards positive real interest rates amid soaring debt-to-GDP ratios and substantial fiscal deficits in the United States. This change, according to Alden, signals a return to a more traditional financial environment, yet it brings to the fore the daunting challenge of managing the increased interest expenses on the nation's hefty debt burden. Despite looming recession concerns, Alden maintains a bullish stance on the commodities sector, attributing the momentum to prolonged periods of underinvestment and notable supply constraints, particularly highlighting energy, silver, and gold as prudent hedges against inflation and economic turbulence. Furthermore, Alden delves into the evolution and potential future trajectories of global financial systems, drawing historical parallels and emphasizing the possibility of a shift towards a revaluation of gold by central banks. Now, we'll show you more clips of Alden, but first, subscribe, and turn on notifications, and check our pinned comment for some massive sign-up bonuses. Enjoy the video.
So I generally don't like the word super cycle, but I do think we're in a commodity bull market. I don't really know how to define a bull market versus super cycle, so I just call them bull markets. But it's basically tied to the Capex cycle. You have a period of rapid capital expenditure, new sources of energy, new deposits all coming online, and eventually you flood the market with too much. You have some sort of economic slowdown, which hurts demand. Then you kind of enter this long period of oversupply, cheap prices, lack of Capex. And going forward, I think that's turning, and it's really been turning since kind of the pandemic bottoms. And so I do think that we're likely in a multi-year, ups and downs, but a longer term commodity bull market until the prices go up enough that enough new Capex comes online and starts the next cycle. So yes, I'm broadly bullish on commodities with different time frames, generally long term, especially centered around energy. In general, when you have a structural, commodity bull market, it's usually because the dollar's weakening, and it's because the commodities are going up in value. So a lot of these things tend to move together. So I just kind of by extension, I'm bullish on silver. It has a number of industrial applications. It still has some degree of monetary premium. Ever since the dawn of the telegraph, the silver has lost a big chunk of its monetary premium, and what I mean by that is the gold to silver range of trading was pretty much between 10 and 20 for thousands of years. And ever since the dawn of the telegraph, where we've relied less on silver's divisibility for money. So basically for eons, gold was like the money for merchants and monarchs, and silver was money for the people. But when we start using banknotes and bank accounts and things like that, and we started abstracting gold, people kind of dropped silver, and so silver got left behind. And in this current environment, we see central banks are stacking gold, not silver. That's where big pools of capital go, because you get a lot more value dense, for what you're doing. And so I think that silver is likely to come along for the ride, and it has its own supply demand characteristics. But I'm broadly bullish on most large commodities. So a lot of it comes down to what the world is using as their settlement asset, their reserve asset, basically the world's money. In the older era, gold was the foundation. And then over time, a gold-backed dollar became the next foundation. And then in the modern era, the dollar itself became the foundation, partially linked to oil, but in general, just kind of the network effect. And so in any country, the state has the ability to kind of impose a currency on people up to a point, but in the international realm, you can't necessarily impose your currency on another area. And so state currencies compete in this global sense for network effects, liquidity, capital markets. If you hold those currencies and reserves, what are you going to reinvest it into? For example, is there a deep enough capital market, treasuries, equities, things like that? And so the dollar has this very strong network effect. And I think going forward, the dollar system is getting very stretched. And I think which way we go will depend on a couple key factors. One is that we could see a more multipolar world where you have the dollar on one side and you have the yuan and some of its adjacent currencies on the other side. That's challenging from a network effect standpoint. The other odds, I think the rise of digital assets, especially neutral open source ones, are yet another challenge. So I think that really the direction of digital assets will affect this because I think they are really taking off. And these other ones are kind of these more analog things that are kind of like the fallback methods, or it's what the powers that be would prefer. And so it's
gold rises despite Fed caution on rate hikes. On Thursday, Governor Christopher Waller said that he was in no rush to cut rates. He also said that January's figures may have been driven by one-time quirks. Many companies raised prices at the start of the year, or they may suggest inflation is stickier than we thought. We just don't know yet. Fed official Patrick Harker, president of the Federal Reserve Bank of Philadelphia, also expressed caution about cutting rates too soon. Gold stocks struggled at the start of the year, performing worse than the metal itself. This was likely due to disappointing operating results and guidance for the sector. Sentiment towards gold stocks has been poor, leading to overselling after any negative news. For example, Barrick Gold saw a drop in its share price despite analysts maintaining their targets. While companies must provide accurate guidance, it seems that negative sentiment towards the gold sector is exacerbating market reactions. Now, we'll show you more clips. Check our pinned comment for some massive sign-up bonuses if you want to add crypto to your commodities portfolio. Enjoy the video.
That's a good way to describe it, that within the context of an overall portfolio, it's a defensive action, even though as its own slice, it can be quite volatile. You have geopolitical risk can happen in the sense that countries, they can do windfall tax profits on it. There's all sorts of things you have to pay attention to, supply demand characteristics of the industry. The bullish thesis could be wrong about the supply side, the demand side. There's a number of risk factors that can threaten the bull market, but I would say the combination of producers have pretty low valuations. A lot of them have decent balance sheets now. They're not reinvesting a lot heavily into Capex. They're just kind of returning value to shareholders and maintaining their Capex. Obviously, some are growing, some are not, but as an industry, it's not super aggressive. And then also the commodities themselves offer, I think, some good long-term holding periods. And the way to think about it is that, the past 30, 40 years of disinflation, stocks and bonds were the big inverse correlation trade. But in more inflationary environments, they tend to have more positive correlation. Higher bond yields put, say, valuation pressure on equities. Like if you can get 6% on a 10-year at some point, maybe you don't want to buy the 30 price to earnings, medium growing equity, right? You say, I'll wait till it goes down to 20 price to earnings, 5% earnings yield. And so in that environment, bonds kind of are less useful for that purpose, or at least long duration bonds. And I think that energy and commodities become the hedge, because when you think of what can disrupt your equity portfolio, well, inflation spikes, material shortages, things like that. And so you want to own some of those to offset some of your assets that prefer disinflation in order. So equities prefer disinflation in order, whereas commodities and a couple other industries kind of prefer inflation and chaos, for lack of a better. And so if you have a little bit of both in your portfolio, they can work well together.
What do you think of today's episode? Is Lyn Alden correct saying that fiat money is broken? Will Bitcoin outperform gold and silver over the next decade? Post your answer in the comments section. Share this video with a gold bug and watch this video because you'll love it. I see you on the other side.